Hello, I'm Noelle Lim on ASEAN Speaks by Maybank. In Singapore, manufacturing growth remained weak in September, weighed down by a steeper decline in semiconductor production. While Vietnam did another jumbo interest rate hike of 100 basis points, and in ASEAN, we look at our downgrades as central banks further tighten. Our analysts discuss their outlook with Suhaimi Ilias, our chief economist.
Good morning, everyone. Let's start with the usual quick recap of the week that was. Stock market movements last week was dominated by steep declines in several mega cap technology and internet related stocks, including Microsoft, Amazon, Alphabet, the parent of Google, and especially Meta, parent of Facebook, following earnings misses and lowered outlooks. Now, this is as Elon Musk completed $44 billion takeover of Twitter and removed a number of Twitter's top executives. Another key market development last week was the swing in US Treasury 10-year yield to below 4% last week, after the jump to slightly above 4.3% the week before. On FX, reports emerged that major Chinese state-owned banks sold US dollars in both onshore and offshore markets last week, following renminbi's recent slide. Macro development last week included ECB's second 75 basis point hike in interest rates on 27 October, after the same quantum of hike on 8 September. But this time, ECB omitted the line about raising interest rates over the next several meetings from its statement. ECB also noted that substantial progress has already been made in withdrawing monetary policy accommodation, while ECB President Lagarde said a recession scenario is looming on the horizon. This prompted markets to reduce their bets on ECB rate hikes, and the euro fell to parity against US dollar. Meanwhile, the pace of Banks of Canada's interest rate hike eased from 100 bips in July to 75 bips in September and to 50 bips on 26 October against market expectation of a 75 basis point hike. At the same time, Bank of Japan wrapped up its monetary policy meeting last Friday, announcing continuation of its ultra-easy monetary policy. We also have the releases of US and China's third quarter GDP. US third quarter GDP grew 1.9% year-on-year. That's the same as second quarter, while on quarter-to-quarter basis, over the same period, the economy recovered by annual rate of 2.6% against the contraction of 0.6%. China's economy expanded 3.9% year-on-year last quarter from a stagnant second quarter 2022 and rebounded Q&Q by 3.9% from minus 2.7%. Business activities in major advanced economies remain weak last month based on the continued below 50 readings in the flash composite PMIs for US, Eurozone and UK. Speaking of UK, former Finance Minister Rishi Sunak officially appointed as Prime Minister to replace Liz Truss. In China, there are new COVID-19 related lockdowns in several cities after the country reported 3 straight days of more than 1,000 new cases nationwide. I think this week, attention will primarily be on several central banks' policy meetings, namely Reserve Bank of Australia tomorrow, US Fed on 1st and 2nd November, Bank of England on 3rd November, and Bank Negara on 2nd and 3rd November. This morning, we'll be speaking to Harbin, Brian, and Juye on Singapore, Vietnam, and Thailand economies, Andy on FX, Anand on ASEAN equity, Willy on Indonesia's retail sector, and Sevi on the Philippines REITs. Let's start with Harbin. Singapore latest economic data showed industrial production basically stagnating with sub 1% year-on-year growth since August. You expect manufacturing sector will shrink this quarter and early next year. At the same time, there is no respite in inflation. Headline CPI remain elevated core CPI climbed further, and consumer price increases are pretty broad-based. So, is Singapore heading into stagflation, or is the macroeconomic conditions a lot more nuanced than what the headline numbers are telling us?
Hey, hi, morning, Suhaimi. So I think it's a bit more nuanced. I actually don't like the word stagflation to describe the current scenario, because if you recall, stagflation in the 1970s were associated not only with just high inflation, but actually very elevated unemployment rates. So there was a lot of slack in the economy. So I think when you look at the situation today, actually the labor market is extremely tight. Unemployment rate has fallen to a 6-year low in Singapore. It's about 2%. And we just got the third quarter employment growth numbers, which were again pretty amazing, up 76,000 of jobs created just for the third quarter. Actually, for the full year, we might even breach 220,000 in total, which would exceed the record levels that was reached during the population and economic boom in 2007. That year as well, the housing market went crazy. So it's a bit different. I think there's still acute shortages, in various parts of the economy. So one, the labor market is still very tight, and I think it's still looking pretty encouraging. We expect employment growth to slow, but it'll probably still be positive growth even in next year. The second point is, I think it's a dual economy. One is that the manufacturing side is clearly weakening and may even contract in the fourth quarter and also in early part of next year, led by the electronics portion. But actually, services side is holding out remarkably well. Part of it is due to the reopening tailwinds that's helping to lift growth, and we saw some of the numbers in the hospitality side that's doing extremely well. But I think there are also structural stories that will probably support the services side. The capital flows that's coming from Hong Kong and China that remains to be pretty strong, and Singapore probably winning of sorts as the international financial center, and also in some sense so far benefiting from the supply chain shifting away from China. So I expect this dualism to probably continue into next year as well. So I think those two are two nuances to highlight in terms of what's happening. So even though manufacturing may be going to a recession, it probably wouldn't feel like the recession for many parts of the economy and for the labor market.
Right. So I guess we can't really take things at face value now. A lot of digging beneath the surface needs to be done. Can you also share with us what have been the recent key changes to Singapore's macro forecast?
So inflation, I think we're pretty much maintaining where we had it already. It's about pretty elevated 4.2% this year for core, headline 6.2%, and actually still pretty high for next year, 4% core, headline 6%. And this is pretty much follows the guidance of the MAS, which now do not expect inflation to peak in the fourth quarter and expects it to remain elevated for next year. Not least because of a 1% GST hike in January. So I think given their kind of guideline, you can pretty much expect the MAS to tighten yet again in the April meeting next year, and they probably have to recenter the exchange rate, the Sing dollar upwards again. So that I think that will keep the Sing dollar strong. For the growth forecast, we have actually raised the full year for this year from the 2.8 to 3.5. I think we were right about manufacturing, but we were wrong about services, which continues to hold up pretty well, because of the reopening. So that's supporting it. Next year, we are looking for growth to slow down to about 1.5%.
Let's move to Vietnam. Brian, we have seen central banks' monetary policy can pivot and have pivoted dramatically. So in the case of State Bank of Vietnam, no exception, with a second round of 100 basis point hike in interest rates in barely a month. Questions is, number one, what prompted such pronounced interest rate moves? And secondly, is it enough or sufficient to meet the objectives or deliver the desired outcomes? What's your thoughts on SBV's next move?
Hi, Suhaimi. So on your first question, what prompted such interest rate moves? So the dong has depreciated around 8.5% year to date against the US dollars. Amid aggressive Fed tightening. Over the past month alone, it has depreciated 4%. That's rather quick. And with currency depreciation comes inflationary risk through higher import costs. The SBV's interest rate hikes are aimed at heading off inflation risk as well as supporting currency stability. In addition, with a hike to the dong deposit rate caps for deposits with a duration of 6 months or lower, the SBV is also trying to encourage more deposit to the Vietnamese banks to improve the banking system liquidity. On your second question, I think that the 200 basis points of rate hikes will indeed help to dampen inflationary risk next year. But regarding the dong, we think that the depreciation pressure on the dong will continue to over the near term, despite the SBV's rate hikes, as the Fed remains hawkish and resolute in its resolve to curb inflation. The spot USD Vietnam dong exchange rate has been at the top, meaning the weak end of the SBV's trading band for around a week. And we think that the SBV may have to do a de facto devaluation of at least 1% before the end of this year, such as either via widening of the trading band or allowing the midpoint of the band, aka the reference exchange rate, to depreciate more. And we are also looking at the SBV to undertake a further 50 basis points of interest rate hikes in the first quarter of 2023.
I mean, aside from inflation, currency effect, any other macroeconomic implications from the 200 basis point rate hike so far this year and the 50 bips that you are pricing in?
Yeah, sure. I think the rise in interest rates will indeed increase borrowing costs and dampen domestic demand, with the impact showing up more discernibly next year, given that the rate hikes were already undertaken at the, at the later end of this year. And next year is at the same time, the rate hikes will show up in the economy. The impact of the rate hikes will show up in the economy. The impact will show up at the same time that global demand is likely to slow significantly and hit exports. I think that the exact magnitude of the rate hikes impact is uncertain and will be difficult to disaggregate given the multiple shocks that will hit the economy at the same time. But we have flagged downside risks to our 2023 GDP forecast, of which currently stands at 6%, already 0.5% point below the authorities' projection of 6.5%.
Okay, thanks, Brian. Let's move to Thailand macro. Julie, what do Thailand's latest external trade data tell us about the state of Thailand's economy, and how will this influence Banks of Thailand's interest rate decision later next month?
Hi, morning everyone. Thailand's export growth was resilient in September at 7.8% growth. That was driven by industrial exports, including automobiles, computers, as well as office products. The Ministry of Commerce attributed the strength in the rebound of chip supply in the region, resulting in the acceleration in production of automobiles. And car exports and production, in fact, reached their highest level so far this year in September, because more chips were supplied to car makers. So we do expect the manufacturing numbers, which will be out today, to be quite resilient as well. The weakening of the baht and falling container freight rates have also helped to boost Thailand's exports. And if you look at other indicators for September for Thailand, it points to a continued improvement in the economy. Farm income surged by 18% as agricultural prices stayed high. And visitor arrivals also climbed further to 1.3 million in September from 1.17 million in August. So currently it's around 45% of pre-pandemic levels. We do expect external demand to weaken in the coming months because of aggressive global central bank tightening, as well as China's lockdowns. And the Thai baht continues to weaken against the USD, which is causing import costs to balloon. The BOT recently revealed that around 75% of Thailand's imports are quoted in USD. Our base case is for the BOT to stick to its gradual tightening mode and raise the policy rate by 25 bips in the next meeting at the end of next month. But a surge in imported inflation, if the baht continues to deteriorate significantly, may result in the BOT turning more hawkish and could possibly hike by a larger 50 bips.
Right, thanks, Jui. Let's bring in Andy into the discussion this morning. I mean, generally, still about monetary policy, central banks, interest rate moves, and all this. But Andy, is there a sense that FX market is also starting to look for signals of pivots by major central banks from being super hawkish to less hawkish, if not going dovish? And how will this affect the FX market in the near term, especially with reference to the directions of US dollar, thus other major and ASEAN currencies?
Morning, Suhaimi. Very pertinent question. In simple terms, to answer your question directly first, I think in the near term, the outlook could still be could prove challenging for dollar bulls in the near term. But I think in some ways, our view is still likely to be a couple of quarters or even maybe up to 3 to 6 months into the 6 month before we see a more sustainable peak in the dollar. So the dollar support will still be there even into first quarter next year, in my view. And the reason why in the near term will be the case is indeed, you've highlighted that the recent and last week's developments, the succession of central bank downshifts in recent weeks, starting off with the RBA coming down to 25 basis points. And last week, possibly the trigger could be the Bank of Canada, which were expected to move 75 basis points, but they moved to 50 and highlighting about the balancing of growth and moving away from the sort of inflation hawkishness sort of perspective. So there has been an increased concern about that peak hawkishness theme running through markets. So that is something that we have been looking into going forward as well. But like I mentioned just now, immediately the answer near term, we're still going to see a bit of dollar support still continuing, but there will be a bit of dollar softness in the short term given what has been developing. One thing I want to highlight is that I think we need to see this in context and should not over extrapolate the theme about the peak hawkishness view, because what has developed out of Canada and Eurozone with their more dovish forward guidance and Bank of Canada's move is that I think inflation situation in Canada, for example, is lower than the US. In ECB's perspective, I think the Eurozone recession is probably already hit. But in US, it is not so. So I think that the cycle out of the US might last a little bit longer. And I think we should not ever extrapolate that theme about that peak hawkishness sort of development. In fact, right after ECB announced, I think inflation numbers out of Eurozone came out a bit higher still. So I think there's a good chance, for example, even RBA could have to dial up the pace again after an inflation surprise. So in that sense, I think we could see eventually still a dollar support beyond the immediate near term in our view, which also reflects eventually to dollar Asia still being supported into end of this year and even into the first quarter of next year. Suhaimi.
But Andy, just curious, if we're going to see a situation where, major central banks, especially Fed, turning less hawkish, maybe and somewhat having some sort of dovish tilt later this year.
Yeah.
Would it not be the case that as far as dollar is concerned, we just move away from the interest rate differential factors that have been supportive of dollar to risk-off sentiment due to concerns about economic outlook to keep dollar strong for maybe longer than what we are expecting at this point of time? Is there a risk of that?
Yes, indeed. But what we probably might see before that is if indeed dovish FOMC comes out this week and Fed Chair Powell signals that in December they might move to a lower sort of pace, I think the dollar might fall off first in the near term. And then eventually, once growth concerns starts picking up again, I think it depends on the extent of growth concerns. If that sort of materializes, I think dollar support could actually be exacerbated further down into end of the year and even into first quarter next year. But and then at the same time, there's also the baseline scenario that the Fed does not do a dovish FOMC and continues with its pace. and concerns on inflation because of the data out of US may not be somewhat similar what it is in Canada and possibly in Eurozone, which also would support the dollar. So on balance, I think the risk of a dollar support continues to be there. Although, like I mentioned, the dovish FOMC risk would actually be the immediate near-term risk to dollar support. And as you know, currencies actually move due to signals and possibly expectations of shifts in the future, so they will move first. And so I think we might see that sort of a trajectory or volatility in the next 3 months, especially when liquidity is quite low. You might see a bit of volatility if there's certain shifts over the next few weeks and into end of the year. Suhaimi.
Sounds like brace for volatility as far as FX market is concerned. Anand, discussion so far has been centering around central banks' interest rate policies amidst growth, inflation, currency worries. From equity market perspective, should investors remain cautious and focus on essentially defensive portfolio, or start to position for the prospect of a less hawkish or more dovish monetary policy ahead?
Yeah, I think it's more the former than the latter. So I mean, at this point, and in our ASEAN Plus this week, a couple of our downgrades sort of highlight the unrolling impact from some of the measures taken earlier in the year in terms of downside to earnings. So in this week's ASEAN Plus, or this edition, we've cut another tech stock, AEMSB, to hold. We have been cutting our ratings for the tech space. Up till now, the ASEAN tech stock earnings have actually been quite resilient, but we are seeing more and more strains coming through of a sudden slowdown in demand and more margin pressures as well. So delayed impact on ASEAN. So again, better to be defensive and wait for these impacts to play out. Another example is impact of fiscal policy on earnings. We've cut Ramayana in Indonesia to sell from hold because of the removal of subsidies and as well as slow job hiring as well for their low income target segment. Again, we are seeing the fallout from fiscal policy in response to what's happening globally, impacting earnings quite negatively. And a third example I'll give you is in Thailand. We've cut the tourism sector to neutral from positive previously. This is more of a valuation call because stocks there have got up about 30%. So stocks like AOT, Central Plaza are now looking quite fully valued. But the point is, a lot of been priced in for sectors which have sort of ridden or leveraged the recovery thesis. And going forward, the outlook is very clouded. In the case of tourism, still seeing challenges from high airfares, also global inflation eating away at affordability. So I think, in a nutshell, back to your question, better to stay defensive now because we're still seeing the impacts of earlier policies this year impacting earnings in a negative way for the next couple of quarters.
So Anand, I guess in this near term, the focus of the market would be more on the result seasons, the earnings as well, and in particular guidance, yeah?
Correct. Yeah, so, when you're looking at the result season, everybody knows ASEAN is cheap right now. You look at the figure 1 here in our ASEAN Plus, most stocks or most indices are trading in the low teens in terms of multiples, minus 1.5 to minus 2 standard deviations against their historical mean. So cheap by historical standards. Some markets are looking ridiculously cheap, like Vietnam, which Brian spoke about earlier. It's now trading high single-digit multiples, and we're still seeing about 20% plus earnings growth for that market. So guidance will be crucial in the third quarter reporting season. But I think definitely in our view, while we are defensive, we would still look to pick up, a sort of longer-term cyclical plays, and also, more interest rate sensitive plays. Should the markets pull back further, because the value is definitely there. And so far, we've not had any major corporate shocks in ASEAN, VPN in Vietnam.
Thanks, Anand. Let's move to Indonesia. Willy, your report on Indonesia's retail sector sounded cautious, despite maintaining a neutral call on the sector. So what are the reasons for this, and how this affect your view on the sectors and stocks outlook over the next 12 months?
Okay, yeah. Morning, Suhaimi. So yeah, basically we see that discretionary spending power will differ across income categories. On one hand, we think this discretionary spending power of mid to low income segment will weaken this year, in 2023. This is due to the fact that we see limited financial support from government. And second one, we see an absence of national recovery program, and we think it's quite premature from our perspective. And third point is that we see rising household energy costs that will dampen the purchasing power of mid to low income segment. This comes on top of an already high unemployment rate and small rises in real wages. On the other hand, we expect the purchasing power of high income earners for discretionary products will remain strong. This is due to the fact that high income segment have high saving rates in Indonesia. So we think with this framework, we remain cautious on mid to low and retail operators like LPPF and Ramayana. And in our view, in 2023, retailing business presents opportunities for high-end retail names like Mitra Di Perkasa, but risk for ASEAN and LPPF. We expect different earnings growth trajectories for retail names in our coverage. Our forecast suggests Mitra Di Perkasa earnings will reach an all-time high from 2023 onwards, while ASEAN's LPPF and Ramayana earnings will return to its pre-pandemic 2019 levels until 2024. We have changed our ratings and target price accordingly for each our retail names. We maintain our MAPI, LPPF, and ASEAN rating at buy, hold, and sell rating, but with new target price of 1,400 rupees, 4,500 rupees, and 425 rupees respectively. Elsewhere, we cut Ramayana ratings to sell with new target price of 500 rupees, as earnings recovery may be prolonged due to weak purchasing power in its target segment.
Yeah, thanks, Willy. Let's make a move to Philippines REITs. Sevi, can you explain to us why you stay positive on Philippines REITs, especially despite, BSP's aggressive rate hikes over the past several months and the seemingly structural changes that is happening, like remote working and some sort of hollowing out in POGO segment since the start of the pandemic?
Good morning. In terms of the impact to dividend growth or DPU growth from the offshore gaming operators and remote work, we find it to be very minimal so far. Offshore gaming operators form a very minimal part of the portfolios of the REITs. Only Robinson's REIT has POGOs occupying its space. The rest are 0% POGO. Most of whatever's left of the POGO exposures is left at the sponsor level. In terms of the remote work, I think one of the realities that BPO operators in the Philippines have to contend with is internet infrastructure. We only have 24% fixed line penetration, and that makes it difficult to do some of the scalable operations that shared services models and knowledge process outsourcing models require. So that's more on an operational standpoint. The other advantage of on-site work is the additional tax incentive from the Philippine Economic Zone Authority, which is the 12% value-added tax exemption. And I think at the rate we're going, where we're already more expensive than India on a call per hour basis, I think any help that we can get to maintain cost competitiveness will help. Interest rates, yes, the REITs have derated or have corrected sharply to kind of maintain a decent spread over the 10-year benchmark, which is now at 7.5%. But if you look at where REITs are trading at now, at 8 to 8.9% implied dividend yield for 2023, I think that offers you already a decent spread over the 10-year government bond yield. That said, given that the yields are okay, decent spread, and then the DPU growth should be unaffected by both the offshore gaming operator situation and the work from home situation, we maintain our positive call on the sector.
Thanks, Sevi. Thanks, everyone. Have a good week.
Get more information from your trading rep and check out the research reports at Market Insights on the Maybank Trade app. Also follow us on Spotify and Apple Podcasts. I'm Noelle Lim on ASEAN Speaks by Maybank.